Welcome to This Explainer. Let's talk about the Utah real estate market. It's a beast, right? Buying a house is one of the biggest financial decisions you are ever going to make, and jumping in without the right tools is, frankly, terrifying. But today, we're going to break down exactly how you can take total control of your financial future before you even set foot inside an open house.
So, you're looking at a gorgeous property online and that little voice in your head goes, wait, can I actually afford this? It's a totally fair question. Navigating high interest rates, property taxes, and hidden costs kind of feels like trying to put together a massive puzzle when you're missing half the pieces. Let's dive into how we can turn all that guesswork into solid, actionable planning.
There's a brilliant quote by the writer Antoine de Saint-Exupéry. A goal without a plan is just a wish. And honestly, that hits the nail on the head for our focus today. If there is one thing you take away from this explainer, it's this. Using a Utah mortgage calculator is the absolute non-negotiable first step. Knowing your numbers isn't just a nice idea. It's the foundation of achieving your home ownership goals.
Okay, here is our roadmap for today. We're looking at 1. The affordability problem. 2. Why use a calculator? 3. Breaking down your payment. 4. Testing real-world scenarios. 5. The 28-36 affordability rule. And 6. Your next steps. Section 1. The affordability problem. Let's tackle the sheer overwhelm of dealing with rates, taxes, and insurance in Utah's incredibly competitive market.
The golden rule here, stop guessing, start planning. Seriously, if you're just guessing what your payments might be, you're playing a really dangerous game with your financial future. You need to understand your total monthly housing costs before you ever make an offer on a house. By plugging your own numbers into a calculator, you get concrete data. You instantly transition from hoping a house fits your budget to knowing for sure that it does.
Section 2. Why use a calculator? Let's talk about why this digital tool is basically a flight simulator for your financial future.
Okay, amortization. I know it sounds like some heavy, intimidating financial jargon, but it's actually super simple. It's just a math formula the calculator uses to spread out your costs. It ensures you pay the perfect balance of interest and principal every single month over the life of the loan. Early on, you're mostly paying interest, but over the years, more and more of that money goes toward knocking out the actual principal balance.
And here's the thing, doing this math manually? Absolutely not. It's slow, tedious, and honestly, so easy to mess up. Digital tools win every single time. A digital calculator gives you instant, highly precise estimates. In a fast-moving market, you don't have time to wait around doing long division. You need answers right away so you can pounce when that perfect house hits the market.
Section 3. Breaking down your payment. Now this is fascinating because your monthly payment is about way more than just paying back what you borrowed.
When you look at a listing price, it's so tempting to just think about the loan amount itself. But your actual payment breaks down into 4 distinct parts: principal, interest, taxes, and insurance. In the real estate world, we call this PITI. This breakdown represents your true, actual monthly commitment. So principal knocks down your loan balance, and interest is basically the fee you pay to borrow the money. Easy enough, right? But then you have property taxes, which fund local public services like schools, and homeowners insurance to protect your massive new asset. Your lender usually collects those last 2 every month and parks them in an escrow account, just to make sure those big yearly bills are covered without you having to scramble for cash. You absolutely have to account for local variables here. For example, here in Salt Lake County, the property tax rate sits around 0.55%. Plus, if you put down less than 20%, you're usually going to get hit with private mortgage insurance, or PMI. These are the exact sneaky details that catch first-time buyers completely off guard. You'll be paying that PMI every month until you build up enough equity, which is why you have to bake it into your calculations from day 1.
Section 4. Testing real-world scenarios. Let's see how all of this plays out in real life by comparing some actual loan variables side by side.
This is where it gets incredibly real. Check this out. A $400,000 home with an $80K down payment gives you a monthly payment of $2,022. But if you jump to a $600,000 home with a slightly higher interest rate, that payment skyrockets to $3,185. A tiny 0.5% bump in the rate, combined with a higher price tag, completely changes the game. Testing these scenarios in the calculator is so empowering because it helps you pinpoint your exact financial comfort zone.
When you play around with these numbers, you instantly see the long-term impact. Tweaking your down payment or your loan term completely shifts your long-term savings. Like a 30-year fixed mortgage gives you lower monthly payments, sure, but you'll pay so much in interest over 3 decades, you could practically buy a second house. A 15-year term means a steeper monthly bill, but the interest you save is absolutely unbelievable. Every little adjustment matters.
Section 5. The 28-36 Affordability Rule. Let's look at the ultimate rule of thumb for budget planning so you stay totally in control.
The rule starts with 28%, meaning your total housing costs, including that PITI we just talked about, should absolutely not cross 28% of your gross income. Financial planners and lenders swear by this metric. If you pull in $10,000 a month before taxes, your housing payment shouldn't go a penny over $2,800. It's the absolute best way to keep from becoming house poor.
And then comes the 36%. Your total debt payments, so that's your new mortgage, plus your car loans, credit cards, student loans, the whole shebang, should not exceed 36% of your income. Following this rule while you use the calculator is a total game changer. It guarantees you avoid overspending, meaning you can still travel, save, and actually enjoy your life while paying for your beautiful new home.
Section 6. Your next steps. You know the breakdown, you know the rules. Now it's time to prepare for the realities of homeownership.
Getting your real-time estimate is literally this simple. Step 1. Type in the home's total price. Step 2. Add your down payment. Step 3. Choose your loan term. And Step 4. Enter your interest rate. Boom! Instant clarity. Just make sure you're using an accurate, pre-approved interest rate for the best results. Toggle those numbers around and see what fits your long-term goals best. But hey, beyond the math, your next steps require a human touch. You're going to need to connect with local Utah lenders and real estate agents to navigate the actual loan programs. Institutions like Zions Bank or Wells Fargo will look at these exact same numbers to check your debt-to-income ratio. Oh, and one more thing. Don't forget that owning a home means budgeting for things the calculator doesn't show, like utilities, general upkeep, and sudden repairs. I absolutely love this quote from an anonymous financial advisor. Financial peace of mind comes from knowing exactly what your monthly commitments are before you sign the closing documents. This right here sums up our entire explainer. Doing this calculator homework up front is non-negotiable. You do this so you don't end up shocked at the closing table.
By sticking to the 28-36 rule and crunching your numbers beforehand, you are locking in your peace of mind. Think about it. What if the only thing standing between you and your dream home in Utah isn't the price tag, but simply not knowing your numbers? So, are you ready to stop guessing? Get out there, run those calculations, and take confident, actionable control of your financial future today.